Okay. So this is all like starting points. Okay. Now, the other thing is I want you all to have a purpose for being here. So if you're not yet a client, one of my purposes for you of being here is to have you become a client. I want to help you do that. So if you'd like to become a client at any point during the course today, you can do that by grabbing a copy of my book. It's completely free. You just cover your shipping. It comes with a book. It comes with a course supervisor to get you through the book. It comes with a coaching call with my team as well. Okay. That's all like $8, $10, something like that. I don't even know. It's just shipping and handling that you cover. If you want to do that, go to jerryfetta.com/B2F promo. Okay, I'm going to post this in the comments. It's jerryfetta.com/B2F promo. Okay, you can grab the book there and you can get started as a client. Now, if you're a client already, I want you to think about what's my purpose? What am I looking to learn today? Right now, the number one way to learn is by asking questions. And so I want to make sure you guys know that this is interactive. Put your questions in the chat. I oftentimes like to go live and actually talk with you on the microphone about the questions because I don't get to talk to everyone right away. You know, I'm the CEO. I don't get to talk with every single person. And so this is a way for me to be able to do that. Okay. So I want to make sure that we have that established as well. And then finally, I want you to think about how you're going to apply the information, right? How am I going to use what I'm learning today? Because it's kind of like, if I don't, I have this example, this example and analogy of, it's like intellectual obesity, right? Like eating calories I'm never going to burn. It's no different for me than learning things I'm never going to apply. Okay, I was talking with someone the other day, and I was telling them, for me, my mindset when I learn something new is that I need to use this within 24 hours or it's gone. Right? If I don't use this in 24 hours, I may as well not have learned it. It's going to be gone. It's going to disappear. Right? And so these are the moments we make those decisions of, okay, what am I going to apply today? When I learn this, what am I trying to apply? And I make that decision early on, right? So today's course is on the Sacred Account. It's about using life insurance while you're alive. Okay, I started in the financial industry at the age of 18. And I heard the same thing about life insurance that most of us hear is, you have life insurance so that if you die, it pays off your debt, it covers, whatever expenses, it takes care of your family. That's all true. That is the primary purpose of life insurance, right? Now, at the time, I was selling something called term life insurance, and that's also what I owned on my own life. I owned term at the time, right? And the difference here, I'm going to sketch this out for you. The difference here is we have a death benefit, obviously, on both of them. But with term, it covers me only for a certain period of time. So it might cover me for 30 years, which means I pay for it also for 30 years, right? I put money into it. And if I die anywhere in the 30-year period, it's going to pay out a death benefit to my family. Now, after 30 years, I don't own it anymore. It's gone. Okay, so the idea back then when I owned this and when I was, working with clients on this was, okay, well, for the next 30 years, let's build wealth so that you don't need life insurance, right? If you do this, you don't need it. You can cancel it. It doesn't matter. Okay. Now, I can tell you the number of people that actually do this, slim to none. It's kind of like saying your car doesn't need a seatbelt because you're just not going to get in a wreck. You're just not going to need it, right? What if I do, though? It's kind of nice to have. Okay. And so here's what would happen is, the term policy, and it's called term because it only covers you for a specific term length, right? Only 2% of the time do people actually die while it's in force. Okay. Not meaning that they don't pay out death claims, meaning there's a 98% chance you're not going to use it while you're living, right? During this 30-year period. Now, after the 30 years, there's a 100% chance you are going to use it, right? If I'm 30 and I start a policy today for 30 years worth of coverage, right? I'm 60, it's gone. The chances of me dying between age 30 and age 60 is 2%, right? What about the 30 years after this? Right? This would be age 60 to 90. From age 60 to 90, I'm probably going to die, right? Maybe I live to 95, maybe. Now, here's the thing, the term, and it's not even 30-year limit on a whole life insurance policy, which is the alternative, it actually would cover me to age 121. Okay. Now there for sure is 100% chance I'm going to use this. Like no matter what, between now and age 121, I'm going to pass away. Right? Now, here's how I thought about this when I started learning about the differences. So this is term, right? 30 years. After 30 years, it's done. You have no more coverage. You have what's called whole life. It pays you your entire life, right? So you contribute to it. At any point you die, it's going to pay out a death claim between now and age 121. If you live to age 121, they just give you the death benefit, even though you didn't die. While you're still living, it's called endowing. The policy then they're just like, fine, you didn't die. Here's all the money anyways. Right? So no matter what, I'm going to get the death benefit on a whole life insurance policy. Now, the argument back then was, okay, well, but term is cheaper. So you buy term, it's cheaper. You invest the difference, usually with Wall Street. Not a great idea, in my opinion, but that's what we were doing back then, right? So here's what I look at instead. So when I'm putting together a life insurance policy, I start with the end in mind, right? What's my goal? Right? Not even my passive income goal. We talk about financial independence, passive income greater than savings, expenses, and taxes. It's not even that goal. Why do I want that? Like, why do I want passive income? Right? Generally, like I just did a coaching call with some of our top trained clients about, an hour ago. And one of the guys was like, hey, I want to set up a center for, youth who were abused to help them become entrepreneurs. Like that was his passion. He was like, that's why I want to be financially independent. I think that's awesome. I think that's beautiful. Right? So if that's my goal, right? Set up youth centers as an example for future entrepreneurs. What if I could secure that anyways? Right? I'm an able guy. So if this is my goal, I'm probably going to get there, but there's a chance maybe I don't finish the job while I'm still living. What if I could make sure this gets funded anyways, no matter whether I get there or not? Right? It's kind of like securing the game before you're even at the end. Okay. The other thing, a lot of times I'll talk with people and they're like, hey, I want to leave a family legacy. I want my family to be secure. Right? So they want to leave, generational legacy. Generational legacy. Okay. I want my kids to inherit money. I want my grandkids to inherit money. I want them to be financially secure. Great. So what if I could secure that now? Right? Like I said, I can build it. I can get there. But what if I could secure it now to where no matter what happens, this is going to be there? How cool would that be? Okay. The number one purpose of a whole life insurance policy, we call it the sacred account, is it has a death benefit. Okay. This death benefit is going to stay in force until 121 years old. If you're the one insured, this will pay out no matter what when you're 121 years old, right? And again, like I said, if you live to 121, it's going to pay out anyways, even if you're still living. Okay. So the death benefit is going to pay out no matter what. So what I would do is I would look at, okay, well, what matters to me? Like, who would this money go to? My family? Would it go to, setting up the youth centers? What cause would it go to? What people would it go to? And I'm going to do that now. I'm going to set up a death benefit that no matter what pays out when I die. No matter when that is, there's no term limit on it. There's nothing. There's no exclusion. It's just when you croak, it's going to pay out to whoever you wanted it to pay out to. And I'm going to link that to whatever my goal is. Right? So if my goal is to set up youth centers, my death benefit is going to fund youth centers. Right? Like I win the game no matter what. Whether I live, whether I die, whether I achieve the goal, whether I don't, that thing's going to happen. Okay. If my goal is generational legacy for my kids, from grandkids, whatever, right? Like that's something I can set up now. Death benefit will fund this. No matter what, I just won the game. Right? So the death benefit part of life insurance in the short term is definitely like, okay, if I have a debt, I want that paid off. If I've got a mortgage, maybe I want that paid off. If I have family, maybe I want income provided for them, right? However, long-term, okay, because I do think, we go back to this initial illustration of the term example in the 30-year period. I do think most of you guys watching the webinar, you're going to pay off your debt. You're going to save the money. You're going to do the right things. And in 30 years, you might not have all these short-term financial emergencies, right? Like, okay, if I die, my family is not screwed because the debt's paid off. Okay. That's probably going to be the case where you've got those things handled in the next 30 years. But I'm talking about beyond this, not just like the small little financial fires that, by the way, we created. Nobody borrowed the money for me. Nobody forced me not to save. Nobody tied me up and said, don't earn income. Like I didn't do those things myself if I'm in that condition. I've been there, right? But I think in 30 years, you're going to sort it out. You're going to be fine. But is this going to happen? The goal. And the death benefit is going to secure that goal no matter what. Okay. Enough said on a death benefit. That's why the death benefit's there. In the short term, it's going to cover all of the little things that need to be covered. In the long term, it's going to make sure my goal happens no matter what. That's the purpose of it. That is the primary thing life insurance is, right? Now, here's the thing is that's not wealth. That is the achievement of a goal. That is the securing of a future, but that's not me having financial independence. That's not me living, without obligation to finances. So just having a death benefit doesn't do that for me. And this is why we use the sacred account. I'm going to talk today about how to use your life insurance while you're living. Okay. So let me share my screen again. And again, if you guys have questions, go ahead and drop them in the chat. We have a few questions that have come up. So one of them, this is from John Moss. How do I bring my family members into the trust? So I think John is asking if he has a trust. So this is a great way to tie this in. So when I have a death benefit with my life insurance policy, okay, this death benefit should actually pay into a revocable living trust. And then the revocable living trust determines where it goes once I die. My beneficiaries, who are those people? Now, these are the beneficiaries of the trust, not the beneficiaries of the life insurance, right? Now, here's why I would do this is I want control over where this goes. So if I wanted to fund a family foundation, for example, and I had very specific ideas on what I wanted to use it for and what the money should be used for, when it shouldn't be used. Like, for example, let's say that I have, kids and grandkids, and I know one of my grandkids is, maybe dealing with the drug problem. I don't want to go give him $200,000, right? Like that's not a good idea. Or I don't want them putting the money with Wall Street, or I don't want them spending it on a house. There's different things I can put in as provisions in my trust that even though I'm dead, I've passed away, that trust dictates what that money can and can't be used for. Who gets it, how they use it, when they use it, how they shouldn't be using it. All of that can be, put into the trust, right? So beneficiaries are those who are going to receive the money. I can add those to my trust. There's no limit on that. I should have a trustee while I'm living. That's probably going to be me, right? When I pass away, I need to have elected somebody as my trustee that is going to carry out the wishes of the trust, right? They're going to act in it's called a fiduciary capacity. They're going to literally be like, okay, we're going to do what's in the best interest of the trust, regardless of what people say, what they want. Here's what the document says. I'm going to carry those wishes out. So I can add people as beneficiaries to the trust. I can add trustees. I would go light on that. I wouldn't add a bunch of people as trustees. I would have probably one person, maybe two tops, a senior and maybe a deputy that make those decisions. So that's how this would work with a trust. Good. So with the life insurance, when we set this up, how do we set this up to where we're using it and winning with it while we're living, right? And I want to actually give you guys an example of what this looks like, because it's something that when I first saw it, it was a complete unicorn, right? I was like, there's no way this is real, because I was brought up that, you never use whole life insurance, you buy term insurance, you invest the difference with Wall Street, yada, 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 right? And so when I was told, hey, you can actually put a life insurance policy together where you can borrow against it and become your own bank, to me, that made no sense. I was like, there's no way this is a real thing. Okay. So I want to show you guys that it is indeed real. And I want to go over how it can be used. Right now, we're going to use some bigger numbers on this just to give you, just to give you kind of an exaggerated effect of what can happen. But you can do this with, as little as $250 a month. But I'm going to show you guys what this looks like if somebody were to take the money that they were putting in their 401k, for example, and put that into the life insurance instead. Good. So I'm going to share my screen and just go over this with you guys really quickly. So this is a sample of a life insurance illustration. Okay. Now this is not an actual illustration. This is, if you're a client, this is not what yours is going to look like. This literally was, I think, something I put on my own illustration at age 28, just as an example of if I had a 401k and I used life insurance instead, what would I do? Right. So most people can put $19,500 a year. I believe that's still the current amount into their 401k. Okay. Now, when they do this, they're locking the money up with Wall Street. They're not going to be able to use it till they're 60. Like, you can't use that money today. You have to wait till you're older. Okay. Now, here's the thing is this money, if I put this into a sacred account, first things first, that's going to buy me about $2.25 million in death benefit. Right. So you talk about securing the goal, like the end of the game is already going to be won. Whoever I dictate to be my beneficiary is going to get this. Now I'm going to dictate my trust as my beneficiary, right? So my trust is going to get it. And then from there, it's going to get distributed out, whether it's to kids, grandkids, businesses, charities, church, whatever it might be, right? Now, when I put this $19,500 in, I'm getting $2.25 million in death benefit, but I also from day one can borrow $15,723 out of my cash value. Right now, the 19.5 is still growing, right? But I want to show you guys, 15,723 divided by 19,500. That's about 80% that I can borrow, almost 81%. So I put in $19,500. This $19,500 is going to keep growing, but while it continues to grow, I can borrow about 80% of it, and the 19.5 still grows. Right now, what does it grow at? It grows at a rate of about 3 to 5% per year. Right. So this money here is going to be earning about 3 to 5% per year, tax-free. Not only tax-free, but also guaranteed against loss, guaranteed to grow. Like I said, can't be taxed. I can grow the money in more than one location at the same time. I can be my own bank. It's protected from lawsuits. It's protected from creditors. It's a unilateral contract. It's got complete privacy between me and the insurance company. My loans don't get reported to the IRS. Like, there's a lot of benefit here. In my opinion, this is the safest place I can put money. Right? So I put in 19,500. I can borrow about 80% of that right off the bat. Let's say I had debt. I had $15,000 in credit card debt. I could borrow the $15,000, pay off my credit card. Now I don't owe the bank anymore. That money is like, there's no more interest accruing, none of that, right? The money that I used to pay to the credit card, I now take that and I pay myself back. Meanwhile, my 19.5 is still growing like it never left. And my savings rate went up. I just did this with someone this week. We paid off some of their debt. And I was like, okay, the coolest thing here that's so easy to miss, your old debt payment that you used to have on that credit card just became your savings rate. Like that's increasing your personal, percentage of income being saved. If you used to pay $200 a month on that debt, the debt's gone. That $200 a month is now freed up. You're paying back your policy loan. That's your bank. That's saving, because the $200, once it pays the loan back, is yours. You can use it again, just like a savings account. You can pull it right back out tomorrow. You instantly increase your savings rate by $200 a month in that example. Right? So that's one example of using life insurance while I'm still living, is I can borrow against it and I can pay off debt. Right? Now, another example would be this. So let's go down a couple more years. Let's say, year 2, right? Year 2, I'm like, okay, I need a car. Okay, well, you could buy a car for 35 grand, could you not? Like most vehicles, if you're not buying like something super luxury, if you are, maybe not, but you could get a good car for $34,000. So I put in 19,500 for 2 years, right? So 19,500 times 2, that's $39,000. Okay, in year 2, even though I've put in $39,000, I can borrow $34,504, right? That's $34,504 of the 39 grand that I've already put in. So that is a percentage of liquidity that I could borrow against. I can take about 88%, almost 89% of what I've contributed in year 2. This 19.5 times 2, this 39K total, is still growing like it never left, even though I'm borrowing against it. So again, I'm making 3 to 5% per year on the 39K. And also at the same time, using this $35,000. What am I going to do? I'm going to go buy a car with it. So I go buy a car, right? Pay cash. Don't use the loan with the dealer. You've got your own bank now, right? But I go buy the car, and on a car payment on a $35,000 vehicle, right? I'm probably going to pay $700 a month. That would be my car payment with the dealer. It might be $500 to $700, but let's say it's $700 a month. Instead of making a car payment to the dealer, I'm going to pay myself back $700 a month because I took a loan from my own bank, right? So look what just happened. I just forced a $700 a month increase on my savings rate, paying zero interest to a bank. I own a vehicle, and also the money I used while I did that's growing the entire time like it never left. Isn't that insane? That's incredible, right? This is like, so just the idea of this blew my mind. I was like, wait, so you're telling me that the money I put in grows even while I'm using it. The reason why is I'm taking loans against what I have. The money is being borrowed against, therefore the balance never leaves. Therefore the balance keeps earning interest and dividends because it didn't actually ever leave, and I'm just taking a loan against it. Okay, I can't do that with a bank. When I put money in a savings account, right? Like think about, like there's two things here. We're depositing money into savings, and we're also taking loans. So think about any time you interact with a bank, when you deposit money into savings, when you pull it out, do they still pay you? No. Okay. The other thing is we're doing loans. We're paying loans back to this banking system that we happen to own. But if I go to a regular bank and I do a loan with them and I pay my money into them with a loan, can I pull that back out? No, it's a one-way loan. If I make a car payment of $700, I can't go pull the $700 back out tomorrow. It's gone. That's their money now. Right? So imagine what this looks like in 5 years. I've been saving $700 a month. You know, over 5 years, this would be a 60-month period. So I've saved up $42,000. My $39,000 grew at 3 to 5% over 5 years, like it never left. And also I have a paid off car. No brainer. If I did just cash, let's say I did not use the sacred account. I'm just like, I have cash. I'm going to go to the dealership and buy a car right now with cash. Okay. Well, when I pay the cash, it's gone. It's not going to still grow. What does a car do? It depreciates over time. By 5 years, your car's worth half what you paid for it. So I effectively, in this scenario, if I pay cash, I've turned $34,000 into $17,000. Right? Now you're going to say, okay, well, yeah, but Jerry, what if I pay myself a $700 a month payment? To where? You're going to put it in a savings account. It's not going to do anything. It's going to sit there and go down in value, and you're probably going to spend it on other things. If you do this, you're going to have the money. Right? So this is with just a car. Okay, the other one, if we go down to year 3, this is with, investing now. I've got $53,000 in cash value. We've put in $19,500 a year for 3 years now. So I put in $58,500 total between these 3 years. 58.5. Okay, that's my total. Now, this is telling me I can borrow this much, right? I can borrow 53,560, and that's of the 58.5 that I put in. So this is a 91.5% that I can borrow off of what I've contributed. And again, same rules apply. If I borrow, the 58.5 still grows like it never left, right? Now, what can I do with $53,000? I can now go invest, right? I can go invest in real estate, and I can go make 8 to 12% in passive income and still have the money that I borrowed growing like it never left, right? So if I borrow, let's just make the math easy. Let's say I borrow $53,000. This is going to pay me, if I'm doing 12%, this is going to pay me about $530 per month in income that I'm going to pay my loan back with. So at the end of this, I've got my 58.5 that grew. Let's just look at the math on this really quick. So I put in 58,500, and I did this for 5 years, let's say, and I'm earning 12%. Okay, in 5 years, this 58.5 is going to be worth about 106K. right? Now on the investment deal, I've got $530 a month coming in for 60 months as well. And then I get my 53,000 back at the end. So I've turned this loaned money, this borrowed money, this became 84,800. If my thing will work, 84.8K, right? So my cash value is now worth 106 and I've earned 84,000. I've turned 53,000, sorry, into 84.8 in 5 years, right? Because the money grew in 2 different locations, right? So these are sorry, my math is wrong on this part. Let me correct this. So the cash value is not going to be worth 106. It's going to be worth a lot less than 106. So the cash value is growing at, sorry, 3%. I had put 12%. So let's say the cash value is growing at 4%. This 58.5 is going to be worth about 72. I was looking at this. I was like, man, this looks really good. It's because my math was wrong. So the 58.5 in cash value, because it grew at 3 to 5%, we split the middle on that. That's 4%. At 5 years, that's going to be worth about 72K. My 53,000 that I invested in this deal at 12% is grown to $84,800. So I combine the two of these together, and that's my gross return. That's what I've made before, obviously before interest and other things that I've got to factor in, taxes, different things that are going to apply. But just comparing apples to apples, I turned $53,000 in a 5-year period into about 150K. Just by funneling it through my life insurance, right? This is what I mean by using this while you're living, right? I can't do this with term insurance. I can't do this with Wall Street. I can't take a loan against my 401k and have it still growing there the entire time and pay it back on my own terms and all this stuff. Like, no, when I take a 401k loan, I can borrow half my balance. The money's gone. It's not still growing when I borrow against it. And I have to pay myself back over 5 years, and they tell me what my interest rate is, and it doesn't work. Right? This, I can take a loan against it. It grows like it never left. I can use it for whatever I want to. I create my own payment terms. Technically, if I never want to pay myself back, I don't even have to. I always do just because it's a good idea, right? And also, I've got $2.2 million in death benefit. Okay. Now the other, so we've talked so far, paying off debt, self-financing a vehicle, and it doesn't have to be a car. It could be any large purchase. You could finance, furniture. You could finance college for your kids. You could finance a wedding. You could finance, the down payment for your house, right? Like, this is what we're really looking at, is we can self-finance. We don't have the things you usually would go to the bank for. You don't do anymore. You go to your own bank. Okay. And the money that you've deposited into your own bank grows even while you use it, right? That's the beauty of the system. Okay, so let's go down a little bit further. So there are a couple other things that I can do with this. So let's go all the way down here. Good, so let's go all the way down to when I'm 60. Okay, I'm 60 years old. My cash value is grown to $940,000. I only contributed to this for 20 years, right? So I went from age 28 to age 48. After that, I stopped. I could put more money in longer, right? But I just showed 20 years, right? Now I have $2.1 million still in death benefit at this point. So let's say I'm 60 and I have a medical incident. Let's say that I get diagnosed with cancer or something like this. This death benefit can be accessed early, right? While I'm still alive, I can use this death benefit to cover a chronic, critical, or terminal illness. Okay, chronic illness, like this would be like cancer. I get diagnosed with cancer. I have medical bills, whatever. I can actually take my death benefit early, a portion of it early, and pay for those things while I'm still alive, right? So that I can live longer if I want to, right? Let's say I get diagnosed with sorry, that was the critical illness. Let's say I get diagnosed with a chronic illness where I can't perform 2 of the 6 activities of daily living, and I have to go into a nursing home, and that costs me 10 grand a month to do. I can pull my death benefit early for that while I'm still alive. Let's say I get diagnosed with a terminal illness and they say, Jerry, you've got 12 months or less to live. And I'm like, well, shoot, I would rather spend the 12 months, like having fun with my family and enjoying life. I can take a portion of my death benefit early to do that as well. Right? Like these are the things that we use life insurance for when we're living. Okay, it doesn't have to just be a death benefit. Now, the great thing on this is, when I look at this kind of a system, I'm like, okay, good. I want to put as much money into it as I possibly can, right? Because the idea would be I want to fund my bank. It's my banking system. I went over this last week. I want to draw this out again, right? So generally with a bank, we've got 4 groups. We have people that are depositors. We have borrowers. We have bankers and shareholders. Everyone is at some point in their life going to be a depositor to a bank. You're going to put money in a bank no matter what at some point in your life. Okay. Some people will be a borrower. If you have a good credit score, you have a good relationship with the bank, you can take loans against it. Basically, nobody's going to be a banker, and basically nobody's going to be a shareholder on the bank. Right? So what does a depositor do? They put money into the bank. What does a borrower do? They take loans against it. The depositor deposits the money. The bank takes that money and loans it to the borrower. They're paying the depositor interest to borrow their money of 0.01%. Whatever your rate is on your savings account, that's the interest the bank is paying you to borrow your money. Then they loan it out to this guy instead on a car for 6%. Right? So they're making money on your money. Okay, now the depositor earns interest. Great, not a ton, right? The borrower has this money, they can go do smart things with it. And then the banker, he's making a profit spread here. He's making profit on the difference between what he's borrowing at and what he's lending at. Okay, then finally you have the shareholder. The shareholder earns dividends. They earn profit on the bank's performance. If the bank is profitable, the shareholders get dividends, right? So as a sacred account owner, like I have, my sacred account, I deposit money and it pays me an interest rate that's guaranteed. My pen is not wanting to cooperate. It pays me an interest rate that's guaranteed. Right? I'm also the borrower. Okay, I'm the borrower and the banker. So I deposit it into the bank, into my system. I'm the banker, right? Now the banker is going to say, okay, I'm making, 3 to 5%. So I'm going to loan this out. I'm going to borrow against it. I might pay an interest cost of 1 to 2 to borrow my own money, but I'm still earning the 3 to 5. Okay, so I'm making profit here. This is how the banker makes money. The difference between the borrowing rate and the rate he loans it out at. That's his profit spread. That's how a bank makes money in most cases. Now once I've done this, I loan it out to the borrower, and the borrower is going to do whatever they want to do with it. They're going to invest it. They're going to buy a car with it, whatever it might be. Well, I'm also the borrower. So I deposit the money into the bank that I own because I'm the banker. I then borrowed against this. I'm now the borrower loaning this out to invest in a deal that might pay me 12%, as an example, right? I'm making money here. I'm issuing the loan to myself, making money here, right? Part of this 3 to 5 is guaranteed interest. Part of it's the dividends. I'm also making money on the dividends. I am every single one of these roles. Even an actual bank can't do this. Like if you're the banker, you're usually not also the depositor and the borrower and the shareholder, right? You might be the banker and the shareholder, and maybe you do some deposits, maybe you do some loans, different things, but usually you're going to be one or the other. You're not all 4. With this system, you get to be all 4, right? So this is when I look at this, the first question I ask is, how much can I put into it? This is where we start getting into some planning questions, right? How do we put money into it? And actually, Philip just asked this: what is the ongoing monthly contribution after the initial investment? So this is called funding the bank, right? So I can fund 2 different ways. I have the option of doing a lump sum. Then I have ongoing contributions. Right? So a lump sum, this part's optional. You do not have to do a lump sum. If you do a lump sum, this means you currently have money saved. And instead of keeping it in the bank or in stocks or in crypto or wherever it is that you have it, you would rather put this into your sacred account. Okay. So you can do a lump sum. There's no limit on how much you can do. You just have to be able to prove where the money came from. proof of funds. Okay, the reason why this is once it's in the life insurance policy, the IRS can't touch it, lawsuits can't touch it, creditors can't touch it, the insurance company can't even touch it. That's your money. They can't change your contract. Nobody has access to that but you. So if you're Pablo Escobar and you're laundering drug money, for example, this is a really good place to put it. So the insurance companies are going to do a really good job making sure you're not Pablo Escobar. They're going to say, hey, we need proof of where this money came from. So as long as you can provide proof of funds and you're not funding drugs, terrorism, etc., they're not going to care how much you put in. Okay, so I can do a lump sum. I've had people do anywhere, I've seen up to like $400,000 as a lump sum where they're just like, hey, I have a bunch of cash. I would rather put it here and I want to do 400K. I've seen as little as $4,000. Right? I've seen as little as zero. There's not a limit on how much you can or can't do on the lump sum. Now, the ongoing contributions, minimum is going to be $250 a month. You can also pay that annually. But generally speaking, if I'm trying to maximally fund this, I want to put as much money as I can. Okay. So the insurance companies are usually going to let me put in up to 15% of my income. Sometimes I can get away with more, but this is generally speaking what we're going to be able to get approved, right? So if I'm making $100,000, then I can do scheduled contributions of 15K. Off of 100, right? If I'm making $200,000, then my base scheduled contributions could be 30K. Right. So about 15%. If I do this as a family, like as a, husband, wife kind of a thing, then I can do more. And that's what I'm going to talk about in a second, is owning multiple accounts. Now, here's how this works. This is called my base contribution. Base, or actually, let's say scheduled, because base might make it sound a little bit like it's the whole life premium. This is my scheduled contribution. Right. I'm also allowed to do something called an unscheduled contribution. So think of it like this. There's a minimum I have to do. And then there's an upward threshold of what I could do if I want. I'm not obligated to, I don't have to. It's not something that I am committed to, but I could put usually, 3 to 5 times more than what I have scheduled total into my unscheduled. So this would be, I could maybe put in 45K total. So I've got my 15 that's going to go in, and then I could drop in throughout the year another 45 as an example. Okay, this is going to be different for everybody, but 3 to 5 times is usually the range I would see on a policy, right? So this means that if I'm doing 15,000 a year, what does that come out to? That's on a monthly basis. That's about $1,250, right? So monthly, I'm doing $1,250. That's, every month for 12 months. And then I could dump in more money whenever, up to $45,000 for the year. There's no, like I don't have to do that monthly. It literally could be a one-off. I could just be like, okay, it's Wednesday. I feel like putting money in my sacred account. Boom, I'm going to do that. Right. So that's the contribution range. Generally speaking, you want to plan for funding as long as you possibly can. Like you're building your own bank. So as long as you have income and as long as you're saving money, why wouldn't you put it in your bank? It's kind of like if you owned your own gas station, as long as you have a car, as long as you're going to drive, why wouldn't you buy gas at your own station? Right? Why wouldn't you buy groceries at your own grocery store? Like, why would I go somewhere else? Right? So I'm thinking with, okay, I want to fund this as long as possible. Right? Now, I can open more than one account. And I want to talk about that next. So let's say that I have a family. I have husbands. I have wife. And I have 3 kids. Okay, let's say that the husband is earning, just to keep the math easy, the husband is earning $100,000 a year. Let's say that the wife does as well. Kids obviously probably don't earn income, so there's no income there. But this means that the husband could put together a 15K annual contribution. And he could have a 45K MEC limit. MEC is your annual limit. Like beyond your scheduled, what could you put in unscheduled? The total of that is your MEC. Right? So that means that the husband total could put in 45K. The wife could as well. If she's making $100,000 a year, she could also do 15K a year. And a 45K MEC limit. Same thing. Good. So between these, that's $90,000 a year that this family could put into their sacred account. Right? Between their base, between their unscheduled. Now, if they have 3 kids, let's say each of the kids wants to do one, you probably could get away with, $100 a month on each child. So that's, $1,200 a year. If we look at the same math on this, this means that we're probably looking at, about $3,600 per year per child that we could contribute. So that's going to be another 10,800 total that I could put in for my kids. Right? So between 90 and 10.8, I can put in about $100,000 a year into my account. That's about half my income. Right? That's a very high savings rate. Putting half my income into my sacred account is no small thing. So this is the strategy of opening up more. So now I've got one on me, I've got one on my wife, I've got one on each of my 3 children. So I'm able to fund and start building these up, and I can take loans against all of them. I can, use them for paying off debt. I can use them for investing. I can use them for large purchases. I can use them for college. I can use them for whatever I want to use them for. Right? Which is very different. When I put money with Wall Street in a 401k or an IRA, I can't use that for whatever I want to use that for. I can't have that money today. Right? Like that's something I have to leave till I'm 60. So I'm saying, okay, I'm going to use this. It's still going to grow the entire time. It's going to benefit me, whether I live or whether I die, my goals are going to be achieved, and I can use it for anything I need to while I'm alive. If I get, critically ill, I can pull money from my death benefit for that. If I end up in a nursing home or needing in-home care, I can pull money from my death benefit for that too. If I end up, getting terminally ill and they say you got 12 months less to live, I can, go do the bucket list with that money too. Right? Like, this is the beauty of the system, is it's so flexible, right? It's not something that I'm stuck with, right? Now, I want to show you, if I look at this from a long range investing standpoint. Okay, so this is the other side of the illustration that I covered. I'm going to share my screen for you guys again. Okay, so this is the chart we were just looking at. We have the age, the annual contribution. We have, the death benefit. We have over here, it says arbitrage investments. Okay, this is me borrowing against my cash value and investing it every time I've got $50,000 available, right? So the first 2 years, there's not this. At the end of year 2, I have, at the end of year 3, I've got 57 grand. I borrow against that. I put that into a real estate deal that's paying me 8, 10, 12%. My cash value is still growing, and I'm paying my loans back now with the income I'm getting from the real estate, right? Now, if I look at this, I can go all the way down, and every time I've got 50,000 available, I can do it again. So there's 50,000 here. Somewhere between year 4 and year 5, you can see there's another 50,000 available. If you just look at, we had 57, now we've got 91. That means somewhere in the middle here, there's another 50, right? We've got now 128 to 169. Somewhere in the middle here, there's another 50. Every 2 years or so, for the first couple of years, I've got $50,000 to invest, right? Once I get down to like year 7, year 8, it's going to be once a year. Okay, now I get down to, year 13, year 14, it's about twice a year, right? And if I keep doing this, here's what ends up happening at the end. I go down to when I'm 60, when I would have just now been able to start pulling money out of my 401k plan. I've got $940,000 in cash value, and I've got $6 million in passive income producing investments that are paying me, let's say it's 12%, which is what I think I based this illustration off of. Okay, $6 million invested at 12% pays me about 60 grand a month in passive income. Right? Now, this just won't happen in a 401k. Like, name one person you've ever met whose 401k plan pays them $60,000 a month in passive income from real assets. Not stonks, not crypto, real assets, like actual real estate pays you passive income because people live there and they pay the mortgage every month, right? So I still have this there, and I still have my cash value, and I still have my death benefit. So total value between what I have invested, what I have in death benefit, what I have here, guys, that's, $8-9 million, like the whole pool. Sure, they're all used for different things. This I can borrow against. This one I can use for, critical, chronic, terminal, or death benefit. This one I'm using for passive income, but that's all value to me, right? Like show me anywhere else that I can take, this was off of $19,500 a year for 20 years. 390 grand is what I invested of my own money. Right? The rest of it's based on the cash value always grows no matter what, even when I borrow against it. And then I do these real estate deals and I just keep reinvesting the cash flow, the passive income to get into more. Pay my loans back, build it back up, borrow again. Pay my loans back, build it back up, borrow again. Right? Like this is to me, this is like the funnest system in the world because it's what I'm actually doing. Right? This is what I experience. It's fun. Like there's like when the stock market's down and you see red on all the charts, I don't experience that. That's not something I deal with. I don't do that kind of investing. Right? Even if I lost, like let's say, that I had an investment that I put money into it and it lost and it went down, well, the cash value is still growing. See, if I went cash into an investment and the investment loses, I'm done. There's no cash, there's no investment because both of them are gone. If I put my money first in my life insurance, borrow against it, the money still there grows. Investment, if it loses, that sucks. I don't like that. I'll be able to at least get a tax benefit from the loss, but my principal still is growing like it never left. Now it's just a matter of repaying myself and I have all of that money available to use again. Right? Like it gives me downside protection in that sense too. So we've only got a couple minutes left. I do want to just, again, real quick plug on the book. So if you are watching and you are not yet a client, you haven't gotten the book, you're interested in learning more about this, go to jerryfetta.com/B2F promo. You can get the book for free. That comes with a supervisor. That comes with a coaching call. Again, that's jerryfetta.com/B2F promo. You get the book for free. You just cover your shipping. All right, so let me dive into some questions. All right. Good. So Cynthia actually had a question on the illustration. So I hope that helps, Cynthia, getting you some reality on what does an illustration look like. This one was built, tailored for this presentation. So as you finish your underwriting and account setup process, you'll actually go through your personal illustration too. Okay, so Avery has a question. Let's say you live to 121 years of age. Will the death benefit be paid out to the policy owner or the beneficiary? So it's going to be paid out to the owner because the beneficiary you didn't die. It's going to get paid out back. It's an endowment, right? So a lot of times, the owner is going to be a family member, so it might go to the same household anyways. The husband sets it up for wife and kids. Husband's still alive. If wife and kids are still alive, it kind of benefits everyone still, but it will get paid back to you. Philip asks, is there an ongoing monthly contribution in addition to the initial investments? And does the ability to borrow more increase with every contribution? Can you just borrow $500 per month or can you continue to contribute? Good question. So Philip, I did do the illustration. So you can put in, more money than the initial investment. So you're going to generally have to. I've never seen the ability to put in just one lump sum and be done. Usually you need to follow it up with monthly or annual contributions for a few years at the minimum. So, and then that was that range. Usually 15% of income is about the max we can put in as a scheduled contribution. And then we generally can do a minimum of $250 a month as your scheduled contribution. Ability to borrow does increase with every contribution. Anytime you put in money, it's immediately going to have your cash value go up, right? So every time I'm putting, contributions in, my ability to borrow does go up. Can you just borrow every $500 per month that you continue to contribute? So you could do that. So let's say I was putting in $500 a month. I could immediately borrow, from that every time, right? I wouldn't do that just because I want to let it build up. If I'm paying off debt, I'm looking at, okay, how much do I need to build up in order to knock out that smallest debt balance? If I'm investing, same thing. What's the investment going to cost me? What do I need to build up for that as well? Mark says, what would you say to someone who has offered a 0% loan from the dealer versus using your sacred account, which charges you 5% on the loan? I would say, if you're doing the sacred account right, your net effective interest rate shouldn't be 5. 5 is your gross rate if you never pay the loan back. Right now, if you pay the loan back, you pay it down over time with the income you're either earning from the investment or the payment you're freeing up by paying off the debt. If you're doing that, then your net effective cost of interest on, instead of 5, it should only be like 2 or 3, right? So my cost is like maybe 2%. I'm still earning 4, which means I could get a loan that costs me 0% and pays me nothing. Or I could borrow from my sacred account, which is a loan that pays me a 2% profit spread to take it, right? 0% is nice, but positive 2 is better. So I'm going to borrow from my own bank and do that instead. CG asks, when you have 50K and you invest in real estate, do you repay the loan with the full rent payment, or do you only repay based on the mortgage you would then have gotten from the bank? So I take the full income, right? So let's say I invest in a deal at 50,000 and it's paying me $500 a month. I'm going to take that whole $500 a month and pay back my cash value, right? And the reason for that is paying back my loan equals saving. It's the same function. It's going into a place, and that place is something that I control and can pull the money right back out again, right? So if I didn't, let's say I didn't pay the loan back, what would I do with the $500? Either going to spend it or I'm going to save it. If I'm going to spend it, this probably isn't a good plan for me. If I'm going to save it, where am I going to save it? The bank? And if I was going to save it in their bank, why not just save it in my bank through loan repayment, right? So I'm going to take the whole income amount. That's always what I do. The only time that I'll base it off of like the equivalent mortgage or car payment is if I'm, let's say self-financing a large purchase, like my Audi. It doesn't pay me money to drive an Audi. I don't make an income from that, right? It's just, I have the Audi, but what would my payment have been had I gone to a bank? And I'm going to take that number and I'm going to pay myself that on the Audi. So I hope that makes sense. Good question. So let me check on Facebook really quick and see if we have any questions there. We do have 1 or 2 minutes left before we wrap up here. And if you have questions on Zoom, still put those in the comments. And guys, again, this is one of the primary things we do for people, is helping them set up sacred accounts. We are one of the best at this, not only in how we set them up, but in how we explain it, right? Like, this is not some fancy fairy tale thing that you sign up for and then you find out it's different and it doesn't work the way you said it did. I've been through that. When I first started doing this with my own money and I put my own money into a policy and I read what everyone was saying online, my experience was very different than what I was told. I was told, oh, you're going to earn a 6% dividend and, your loan rate's 5% and you're going to make money on your money no matter what and all this other stuff. Well, it turned out that my dividend rate was gross rate and I was only actually making about 3 to 5%. So when I borrow and I don't pay myself back and my interest costs me 5, I'm not making money on my loan, right? So this is not a story. It's not a neat pitch. It's actually math. You have to make sure the math works. So this is one of the things we do with our clients, is we make sure that obviously they have the concept, they can use it, but the math really does work. Okay, I had a client that they were shopping other people and they went through the entire area that they lived in and they couldn't find a single person that could design an illustration the way we could. And when they showed them what we designed, all of the other agents looked at them like they were crazy. They're like, I don't know what this is. I've never seen this before. Right? I don't know how they did this, basically beats me. That was the answer they got, right? So if you're watching, the reason I share that is if you're watching and you're interested in setting up a sacred account, the first thing to do is get the book. Okay. Education comes first always. I'm always going to tell you that. Get the education, study, get the competence before you dive in, and then get with our team. We'll help you with, what contribution sizes should you do? How should your account be designed? What are you looking to use it for? And we'll go through and tailor the whole process for you. Okay. Good. I think I see a few more questions we'll answer really quick. Okay, so Steve asked, my term policy cost me $3K per year for the next 20 years. Putting money into a policy, I need to factor in that I no longer need the cost of the term policy. That actually increases the concept of my rate of return. Yeah, so you can cancel the term, right? So that's something you would save. You would be bringing a $3,000 per year back into your budget, So that definitely is a internal rate of return. That, Steve, that would be unique to your situation. If someone else didn't have that, obviously they're not going to factor that in, but for you, you do. Philip says in a normal investment, 20K down and 1667 per month for 20 years at 12%, well, you'd do 1.86 million. Yeah. And that's the, if you're not having the double dipping effect, that's definitely going to be a lower return. And that's the difference of putting, cash into something. You have to understand, anytime I take cash and I go directly into, whether it's paying off debt or whether it's an asset, that cash is gone. I can't also have it, right? So with the life insurance, I can also have it. It's still growing the entire time. And I've got the cash there growing in the investment or whatever the debt was that I paid off. So I'm really getting the double dip effect. And that is the whole compounding interest thing is true, but it has to be real compounding interest, and the sacred account definitely is that. So guys, I don't see any other questions. I am going to wrap up for today. We will be back again next Saturday, 1 p.m. So you'll be sure you tune in again. We do have our Money Monday call with Nano Aquino at 4 p.m. Eastern time on Monday. He's going to be going through the book Liar's Poker. If you have money with Wall Street, you need to be on this call. I know I keep saying that, but it's kind of like if you kept going to a restaurant and you didn't know that the cook had been spitting in the food, you would want to know about that, right? Like you would probably not want to eat there anymore once you found out. Now, do they want you to know about that? Probably not, because they'd lose customers. Wall Street's the same way. Like if you've got money with them, you're eating from their kitchen. Don't you want to know what goes on behind the closed doors? And that's what the Money Monday call is going to be on this week with Liar's Poker. Again, that's 4 p.m. Eastern time with Nano Aquino. If you have not gotten the book one last time, go to jerryfetta.com/B2F promo. You can get the book for free. You just cover the shipping. We will include a course supervisor and a free coaching call as well. That's all I've got for today. Thank you guys for watching. Like, follow. See you again next week.